AI in banking, securing high-stakes financial intelligence. Welcome to day 15 of AISec Intel. Today, we enter one of the highest stakes battlefields in the world, the future of banking secured by AI. Picture this, a massive steel vault door, like the one you see on slide 1, slowly opening. But instead of gears and metal, the inside glows with circuitry, digital patterns, neural pathways. This is no longer a bank vault filled with cash. This is a vault of intelligence, financial intelligence powered by AI. In banking, every decision, every signal, every algorithm carries consequences measured not in inconvenience, but in billions of dollars, reputations, market stability, even national security. And today, you and I will walk through the heart of that vault. You'll understand why AI is not just a competitive advantage, it's a battle for survival. Why banks that fail to secure AI will face fraud unlike anything seen before. Why attackers now target algorithms, not accounts. And why the future belongs only to those who build secure intelligence, not just intelligence. So take a deep breath, slow down your pace, and step into the world where finance meets AI and AI meets risk. On day 15, AI in banking, securing high-stakes financial intelligence. Why banking is the highest risk sector for AI? Banking, the industry where opportunity and danger live side by side. Banks deal with trillions of dollars every day. Every second, money moves across the world. But behind that movement sits logic, rules, and now artificial intelligence. Let's pause here. Why is banking the most dangerous place to deploy AI? Because the stakes are unforgiving. A single flawed model, a single compromised algorithm, a single manipulated data point can trigger a chain reaction that affects millions. Slide 2 reminds us $5.8 billion in annual global fraud losses, 78% of banks using AI without full security audits, real-time decisions with zero rollback regulatory penalties, averaging $2.3 million per breach. In banking, there is no undo button. There is no let's retrain the model later, a delayed decision, a misclassified transaction, a hallucinated response can freeze customer accounts, authorize fraudulent transfers, or trigger compliance violations. AI now approves loans, detects fraud, manages liquidity, assesses market volatility. These aren't small tasks. These are foundational pillars of global finance. And when AI is attacked, or when it goes wrong, the damage isn't local, it's systemic. This is why AI security in banking is not optional. It is the last line of defense protecting financial stability. Let that sink in. Where AI powers modern banking. On slide 3, you see the map of modern banking intelligence, fraud detection, risk modeling, credit scoring, KYC and AML, customer engagement. Let's walk through these slowly. Fraud detection. AI now analyzes millions of signals, from location patterns to behavioral biometrics, to detect suspicious activity before money moves. Fraud used to be reactive. AI makes fraud detection proactive. Risk modeling. Neural networks study volatility, liquidity, credit default probability. They read markets the way experienced traders do, but in microseconds. Credit scoring, this is revolutionary. AI now allows millions who were invisible to traditional systems to gain access to credit, using alternative data, mobile signals, spending behavior, and more. But with this power comes responsibility. Bias must be eliminated. Transparency must be enforced. KYC and AML. AI verifies documents, detects forgeries, uncovers hidden networks of criminal entities, and tracks suspicious patterns in real time. Money laundering no longer hides in complex data. AI illuminates the shadows. Customer engagement. Conversational agents now assist millions with personalized financial guidance. They know context. They learn preferences. They improve customer experience. AI is not just helping banks operate, It is becoming the nervous system of modern finance. And with such power comes the need for deep, uncompromising security. Critical threats targeting banking AI. Now, we turn to the dark side. Slide 4 shows the 6 greatest threats to AI in banking, and each one deserves your full attention. First, adversarial manipulation. Attackers craft inputs that fool models. A fraudulent transaction suddenly looks normal. Billions in controls bypassed by a few pixels or modified data points. 2. Fraud amplification. AI doesn't just help defenders scale, it helps attackers scale too. Instead of attacking one account, they attack thousands simultaneously. Third, synthetic identity abuse. Real data mixed with fake data. AI-driven KYC systems get tricked, and a criminal walks into the system with a perfectly engineered identity. Fourth, biased scoring models. This is not just technical risk, it is regulatory, legal, reputational. A biased model can deny loans unfairly and trigger lawsuits, audits, and penalties. 5. Model inversion attacks. By querying a model repeatedly, attackers can extract sensitive customer information. Think about that. The model becomes a leak. 6. Deepfake fraud. Synthetic voices, synthetic faces. A CEO calls to authorize a transfer. A customer logs in with a perfect deepfake. This is today's reality. AI is powerful for defenders and for adversaries, and understanding these threats is the first step toward neutralizing them. AI-driven fraud detection architecture. Slide 5 brings us into the engine room of modern fraud detection. Imagine a system capable of looking at a transaction for 0.3 seconds and determining with 87% accuracy before funds move whether the user is legitimate or not. This is AI-driven fraud detection. It works through 3 core mechanisms. 1. Anomaly detection. Every customer has a behavioral fingerprint, their spending pattern, their typing rhythm, their device and location habits. AI learns this and flags anything unusual. 2. Behavioral analytics. It doesn't just look at the transaction. It looks at how the user behaves online, subtle micro behaviors that humans cannot detect. 3. Pattern learning. The model continuously adapts as attackers evolve. Every new fraud attempt strengthens its defense. The numbers on slide 5 are remarkable. 87% of fraud detected before transfer completion, 42% reduction in false positives, 0.3 seconds average scoring time. This is the holy grail of banking security: high accuracy, low friction, minimal false alarms. But remember, when this AI layer is compromised, when the model is poisoned, when adversarial data enters the pipeline, the entire fraud detection engine becomes a liability. And that is the challenge banks must confront. AI in KYC and anti-money laundering. Now, let's step deeper into one of the most complex and regulated areas of banking: KYC and AML. On slide 6, the visuals show futuristic identity panels, biometric scans, holographic documents. This is exactly what modern verification looks like: machine-driven, data-rich, and incredibly fast. But beneath that speed is intelligence. Let's walk through the 4 pillars that define AI-powered KYC and AML. 1. Document verification. AI uses computer vision to examine ID documents at a microscopic level, inspecting fonts, textures, security markings, and subtle micropatterns invisible to the naked eye. Counterfeit documents that once bypassed human review are now caught instantly. 2. Biometric matching. Facial recognition, liveness detection, frame-by-frame analysis. The AI ensures the person behind the camera is real, present, and matches official documents, eliminating a huge portion of identity theft attempts. 3. Entity resolution. This is the secret weapon. AI doesn't just check names, it checks networks. It connects records across banks, countries, corporate registries. It identifies beneficial owners, shell companies, and hidden relationships. This is how criminals using layered entities are finally exposed. 4. Transaction monitoring. With behavioral analytics, AI understands patterns, how a customer spends, where money moves, what timing is typical. When something deviates, AI notices instantly. It does KYC and AML used to be reactive. AI makes them real time, intelligent, and far more accurate. But with this power comes immense responsibility. A flaw here doesn't just cause inconvenience, it opens the gates for laundering, terrorism financing, cross border crime. This is why AI security in KYC and AML must be airtight. Risk scoring and credit algorithm. Transparency. Slide 7 brings us to one of the most sensitive, most debated, and most regulated areas of AI in banking: credit scoring transparency. Imagine this scenario. A young woman applies for a home loan. The AI model denies it, but provides no explanation, just rejected. This moment is more than a denial. It's a potential regulatory violation, a violation of trust, a violation of fairness. Around the world, regulators now demand one thing: explainability. This isn't optional. Institutions must show why a model made a decision. The Equal Credit Opportunity Act, the GDPR's right to explanation, ISO standards, and emerging AI regulations all insist that banks must justify automated decisions. On slide 7, the image of a high-tech credit risk dashboard symbolizes this transparency movement. Let's break it down. Fairness is no longer a moral ideal, it's a legal requirement. Models cannot discriminate against groups or perpetuate historical biases. They must undergo fairness audits, demographic parity checks, bias detection, independent validation. Techniques like LIME, SHAP, and interpretable models aren't just academic ideas, they are compliance tools. And yet, there is a tension, a deep, unavoidable tension. The more interpretable a model becomes, the more accuracy may decline. Banks must now choose a slightly less accurate model that is transparent or a highly accurate model they cannot defend. The regulators have already chosen transparency, fairness, explainability. This is the new reality of AI governance in credit scoring. Vulnerabilities in banking AI models. Slide 8 exposes a truth many institutions avoid. Even the most advanced AI models have weaknesses, and attackers know how to exploit them. Let's walk through the 4 vulnerabilities shown on the slide, with full awareness that each one can collapse an entire financial system if ignored. First, data poisoning attacks. Imagine a criminal slowly injecting corrupted data into your training pipeline. The model begins to misclassify certain fraud patterns as legitimate. Everything looks normal. But a backdoor has been created, silently, invisibly. This is one of the most damaging attack vectors in AI. Second, bias reinforcement loops. Think about this carefully. If your model is trained on biased decisions from the past, it will continue those biases and amplify them. 3. Hallucinated financial decisions. LLMs can hallucinate with confidence. In banking, this is not amusing, it is catastrophic. A hallucinated regulatory interpretation could violate law. A hallucinated risk profile could crash a portfolio. A hallucinated guidance to a customer could trigger legal consequences. 4. Concept drift and data staleness markets shift. Customer behavior evolves. Fraud techniques change. Models trained on yesterday's reality fail in tomorrow's landscape. Stale data is dangerous data. The message of slide 8 is clear. AI is powerful but fragile, and only continuous monitoring, adversarial testing, and rigorous validation can protect banking systems. Securing AI training data. Slide 9 is the heart of trustworthy AI, training data security. Let's slow down here, because everything, the fraud detection, the credit scoring, the KYC systems, all of it rests on one foundation: data. If your data is compromised, everything built on top of it becomes compromised. Here are the pillars highlighted on the slide. 1. Data integrity, cryptographic hashing, dataset signatures. Provenance tracking. These ensure that no one tampers with the training material without detection. Second, multi-party annotation. High-quality labeled data doesn't come from shortcuts. Multiple reviewers must validate every label to ensure accuracy and fairness. Human bias must be detected, not absorbed by the model. 3. Privacy protection techniques like differential privacy, federated learning, synthetic data protect sensitive customer information while still enabling high-quality model training. 4. Continuous monitoring. Training pipelines cannot be static. Every update, every retraining cycle, every new dataset must be checked for anomalies, inconsistencies, and security violations. 5. Secure data lakes. The entire storage architecture must be hardened. Access controlled, encrypted, monitored. Soft pause. The quality and security of your training data determine everything: fairness, accuracy, compliance, and resilience. Banks that secure their data secure their models. Banks that ignore data security invite systemic failure. Artificial intelligence in payments and transaction security. Payments, this is the front line of financial crime. Billions of transactions, every second, every day. Slide 10 explains the four-step life cycle of AI-enabled payment security. Let's walk through them. 1. Transaction initiation. The moment a customer taps their card, enters UPI, or uses a digital wallet, AI begins analyzing device fingerprints, typing cadence, geolocation patterns, and behavioral biometrics instantly. 2. Real-time scoring. In under 50 milliseconds, AI evaluates merchant category, location velocity, spending patterns, transaction anomalies, network relationships, historical behavior, account risk profile. This is intelligence operating faster than human perception. 3. Risk decision. AI decides, approve, decline, step-up authentication, and here lies the finesse: adaptive friction. Legitimate users experience speed. Suspicious users face barriers. 4. Continuous learning. Fraud attempts, false positives, analytic shifts, all feedback into the system. The AI becomes smarter, more experienced, more precise. The numbers on slide 10 are extraordinary. 99.97% transaction accuracy, 94% fraud detection rate, 47 milliseconds scoring latency. This is the modern payment engine. But there's a truth we must acknowledge. If attackers compromise this AI, they compromise everything, the entire payment ecosystem. This is why securing AI in payments isn't a priority. It's a necessity.